Hello, everyone. It's Friday, November 3rd. It's time for another market update and just perspective on where we are and what's happening with Fish Creek. So let's get right to it. I'll try to be sensitive to the time. There's a lot to cover. The S&P is up 5% on the week. It is definitely has been a risk on week. Even today, you're seeing all the indices higher. Oil is down today. The dollar and gold are up. And the VIX, the volatility index, is down to 1532, the low 15s. What could, attribute to such a up week? Well, let's run through a couple of things. So we started the week with the month end, and a lot of people will say that you can see window dressing around month end with the big fund managers and portfolio managers wanting to make their books look good. So we started the week with that. We're also at a seasonally, positive time in the market. You got the end of October and then the 1st of November that can kick off a positive time in the market. So there's that going on. We did have the Fed out on Wednesday. They did hold rates, which was what everybody expected. So the rates are staying steady. The Powell is kind of sticking to a script of getting inflation down, watching the unemployment rate, but the questions from the presser kind of got him to, well, the take from the presser was that they are done raising rates, and people wanted to try to just hold on to that and really take that out of his comments. Whether he really said it or not, could be up for debate. But the markets really liked that on Wednesday, and a lot of people think that the Fed is done raising rates and that they're just kind of going to hold them where they are, maybe keep them higher for longer, and just wait and kind of see what the impact of all the rate hikes are going to be. So that can trickle into 2024. There is one more Fed meeting in December. They talked about raising rates by another 25 basis points, so they haven't done that yet. So we'll see what happens in December. There's been a ton of volatility despite even the S&P being up 5% on the week. You can see in the background again, this is another chart, or the same chart of the S&P 500 on a daily basis. And as you look over here down on the right, again, I don't know if my mouse is going to show up, but you can see even with this big jump up this week, you can see these green arrows just one right after another. We're basically right back to where we were 2 weeks ago in the middle of October. So October just had a ton of volatility, and a lot of that volatility was coming from the bond market. That's another reason we've seen stocks up this week, and I would argue that it's the main reason we've seen stocks up this week. Bond yields have dropped. So, generally speaking, bond yields go higher, the market goes down. Bond yields go lower, the market goes up. Well, there has been a ton of volatility on the long end of the curve. That means when you hear long end of the curve or the long bond, that is referring to a 10-year bond. That is what's been crazy volatile. And that, it got up to 5%. Hopefully it peaked around 5%, right over 5%. And that has come down to even, I think, around 4.5, now or so. So that's one reason. And I would argue the main reason that we've seen stocks do so well this week is that you're starting to see that 10-year bond come down on the interest rate. There was some other data that was very interesting um, on just the up and down for the week. This is from David Bahnsen with the Bahnsen Group. They're a big firm out in California. So October represented the third consecutive negative month in all three market indices. August and September, were down also. October, though, was much more of a roller coaster. It started the month off with a 600-point drop in the first few days of the month. And then we reversed and had a 1,000-point increase from the October 6th low to the October 11th high. And then it dropped again 1,500 points from mid-month to the late month. That's what you can see in my chart here on the S&P, only to go back up again 1,100 points from the low of last Friday. So it's the volatility for October has been crazy, and it definitely, you can see it in the chart here. So October 9th, we're down here, we go up, and then middle of October, we're back down to those lows last Friday. Then here we are up 5% this week. So what does that mean for Fish Creek? And so what I've been focusing on, I want to make sure you hear this part, is just really the fundamentals of a business is what we need to focus on. Just the bottom up, real enterprise. What are companies making, and what are good, solid individual companies? So you will see in your portfolios, not everyone is the same, but you will see some of these good, strong companies that I would consider at least good, strong companies that meet that criteria. Because for a fundamental, long-term investment thesis, we cannot really focus on the short-term noise of even bonds and geopolitical World War III tensions and the headlines that will just scare you to death. So if we can focus on good, solid companies with real enterprise that have strong fundamentals, that's what you're going to see in your portfolio. In addition to that, a good bit of your portfolio is still going to have a 5% money market interest rate. I'm still capturing that. Like, it's going to range from 5% to 5.3%, but you're also getting a money market rate at that which is excellent. So we're capturing that. And then the third thing you're going to see is just options that I have always talked about, and that we have really, been able to, take advantage of over the last several years. You're going to see option activity. So you're going to see covered calls. You're going to see some selling, some puts, some of those things that I've always done that have generated good returns. So three main things that you're going to see in your accounts at this point. So you're going to see cash getting 5% to 5.3% return on the cash, which is, we've got to capture that. That is important because of all the geopolitical risk and all the headlines that are out there. So we want to capture that risk-free rate. You're going to see good, strong companies with real enterprise that are making money, that have strong fundamentals. And then you're going to see a small portion of your account that is going to be capturing option activity and just trying to increase alpha on the overall, return of the account. So that's kind of the strategy right now. That is a very good long-term strategy also. So if you got any questions, please let me know. I hope you have a great weekend.